So the question should be not, am I getting the rate that I want, or am I getting the lowest rate or the target rate I had? It should be, am I getting a rate and am I paying fees that will put me in a position to be most profitable by the time I plan to pay this loan off, whether it's through a refinance or a sale, or I guess if you're expecting some massive inheritance or something over a short period of time, that could be accounted for. You certainly shouldn't consider a 30-year look forward, and that's where lots of people get confused.
Yeah.
Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Brock Lassick, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth. Client calls me, and he's one of those clients that he's a Google fiend. Like he and Google get along really well. And
Google or chat?
Google.
He's
an older guy.
He's old.
He's an older guy. Yeah. He's an older guy. And we jump into the consultation, and he doesn't even want to talk about anything else. He's like, okay, I want to pay 4 points for my loan, and I want to get down to this rate. I'm like, okay, let's back up for a minute. First of all, it's not even legal for us to charge you 4 points. And why do you want to do that? And then, long story short, it turned into him paying no points and keeping a lot of that cash liquid. But
why did he want to pay 4 points?
That's just what he read on Google, is you need to pay 4 points in order to get where the rate he wants to be at, which he wanted to be at 5%, which the paying 4 points didn't even get him to 5%.
Not even close.
It's like, okay.
Not even close.
Yeah. So I just don't. I wonder where, I feel like we're in the age of information where there's so much information, you don't even know what's true, what's not.
It's interesting you say that, and it's getting even worse. Like, I don't know, chat seems to be pretty smart, but there are so many people doing what you and I are doing right now. The difference is, and I mean, I guess we're biased, but we're really good at what we do and what we talk about. We know it really, really well. There's lots of people that talk about stuff, and they don't even know it.
Yeah, it's true.
So you got to be cautious where you're getting your information.
Even chat will be wrong a lot of times too.
Yeah, you have to be knowledgeable.
Yeah, for sure.
Like, say, wait a minute, that's wrong.
I uploaded a closing disclosure because I want to see what it would do.
Yeah.
Just a couple minutes ago, and it was completely wrong. I had to teach you, per your advice, I had to teach you how to do it, and it was. Yeah. So it's interesting. I wonder how many people are just trying to do the same thing, but hitting pitfalls because of it's not quite caught up yet to where it should be.
For sure. And I think the biggest thing is, like, so much is opinion, and there are a lot of well-meaning people that have opinions about mortgage financing and real estate investing. And so really what we want to talk about today is, are mortgage points actually worth paying? And we want to dive into what mortgage points are, because there's a variety of different ways you can pay mortgage points. The two most common are discount points and origination points. So discount points, you pay these to get a lower rate. That's what TJ was just talking about. That's what that client was just talking about.
You're prepaying the interest, essentially.
Kind of. I mean, really, you're just paying a fee for the right to have a lower interest rate. It's an upfront fee. Discount points for a permanent buy down, which is what that client was talking about, are non-recoverable costs. You pay them, they're gone forever, no matter what happens, which is, I think, a dangerous thing. And then there's origination points. We'll talk about something else later, but origination points are fees charged by a lender to originate the loan. Now, sometimes you'll hear lenders say, here's a rate and we're not charging any discount points or discount fees, but they are charging origination points and fees. And those, the laws around how those have to be disclosed in advertisements and different disclosures they differ from discount fees. So they can say, I'm not charging discount fees, but they're actually charging origination points. When in reality, if you're paying any points, at least for a lender like most of the lenders, and like us for sure, because we don't charge origination points, it is just to get a lower rate.
Yeah. Well, I find it funny because I'll talk to some clients and they'll be like, oh yeah, it's no fees. I'm getting a rate it's 0.5% lower than what market rates are right now. And I'll say, okay, well, what's the APR? Well, APR is way higher. So there's fees in there somewhere. It's just
but
not
the person
being
said there's
clear.
no discount fees.
Exactly.
And it's like, it's a murky business. And that's what I always tell clients is like, let us help you clear up the waters of confusion in our business, because you can just skin the cat a little bit different way and it sounds different, and you can get sucked into something, and then before you know it, you're in a loan you don't want to be in, and you don't have time to reverse course and find a lender, and so you're stuck in a loan for long term and probably sinking thousands, sometimes tens of thousands of dollars in costs that, had you known the full story, you'd probably you would have chosen to avoid.
Yeah, well, there's so much red tape in our business.
Yeah.
That, I mean, and at the end of the day, we all get the funds from the same place. So we can help uncover that red tape and all the murkiness to show you the true numbers.
Yeah. Yeah. Because if you're hearing one rate is lower than the other rate, there's fees involved somewhere, because it's just, there's not a magical rate anywhere.
So I guess 1 point, when we say point, that means percent. So 1 point is 1% of your loan amount. So if you have a $500,000 loan, that 1 point would be $5,000.
Yeah,
$5,000.
Yep, $5,000. So 1% of whatever you're financing. Some people get confused that it's on their sales price. That's not the case. It's what you're financing. So our discount points, a good deal. Should you pay them? I say no. Or should you pay any points? Generally speaking, I think we just say no. And the reason for that is simply a break-even period. So we don't look at, so many clients get stuck in this tunnel vision approach of mortgages. Payment has to be this, or like your client, rate has to be this, and they just get stuck on this thing, and they're missing the whole picture, and very often they're tripping over dollars to pick up dimes, or something maybe even worse than that. And so paying a point, so like let's say you paid one discount point or 1% of the loan amount on a $500K loan, $5,000. That, generally speaking, reduces your interest rate by 0.5%. So you pay 1% in fee upfront, non-recoverable, to get a 0.5% lower rate. On a $500K house, that's somewhere around $160 some odd a month. So the break even, this is the real trick. The break even on that is 5,000 divided by 167, let's call it. It depends on where rates are at exactly, but $5,000 divided by 167, which is the 1% savings on a $500K loan. That's more than a 30-month break even, or 2.5 years. So the question should be not, am I getting the rate that I want, or am I getting the lowest rate or the target rate I had? It should be, am I getting a rate and am I paying fees that will put me in a position to be most profitable by the time I plan to pay this loan off, whether it's through a refinance or a sale, or I guess if you're expecting some massive inheritance or something over a short period of time, that could be accounted for. You certainly shouldn't consider a 30-year look forward, and that's where lots of people get confused.
Yeah, especially because on the docs that we send, the legal docs, it shows like the amount of interest that you'll save and whatnot over 30 years.
Yeah, and it's hundreds of thousands of dollars.
So it looks like, oh, this is a no-brainer. I spend
$5,000 to save 300,000.
Exactly. Yeah. So I don't blame clients for thinking that if they're not educated and really haven't done enough research. But the average client doesn't, they probably redo their loan every 3 years, 3 to 5 years.
Probably 4. I think 4 years is like the official average. And right now, with rates being elevated and the expectation that rates are going to come down, you're likely to be out of the mortgage that you're going to get into now in probably less than 2. Now, granted, we've been saying that for a while, but so don't mark our words here. But it seems pretty likely rates are going to drop within the next couple of years, and you're going to refinance and get out of that mortgage. But within 4 years, even when rates were at the lowest of lows, people still changed their mortgage an average of every 4 years. We might be starting to see averages go up a little bit now from like the 2020 era, and it's 2025, so you see fewer people changing their mortgage in those first 4 years. But even still,
well, especially if it's people that, sorry I cut you off, but the people that are first-time homebuyers or people that aren't putting down 20% or 15% to avoid mortgage insurance, you're definitely going to refinance this, even if rates, maybe if they stay where they're at, worst case scenario. Or
as equity goes up. Like we've got clients, it's happening more and more frequently where debts are accumulating and rates are up, sure, but equity is up on those homes, especially for those people that bought with the super low rates. Well, now you've got the equity to consolidate debt or do home improvement or whatever. And now suddenly it's like, well, fine, I guess I'll take the higher rate because this other thing is more important. So there's always reasons to change your mortgage.
Yeah.
Even if you don't expect, like what you expect to happen in the future today is probably wrong in almost any sort of decision, I guess. Like whatever, but especially on mortgages. Like you're looking forward and you're like, no, for sure, 15 years, I'm going to keep this. Well, you didn't expect debt to accumulate. You didn't expect a kid to get married. You didn't expect a sickness to happen. You didn't expect a car wreck to happen. You didn't expect an investment opportunity to come up. Like there are so many reasons that are not just about the lowest rate and lowest payment that you want to leverage your home and you kind of don't care about the rate, or suddenly the priorities shift and you don't care about paying the house off super fast. Like a few months ago, we had a client that we took from a 15-year loan, super low rate, 2.25% or something like that, to a 30-year, only because they were like, we don't feel confident about the job security right now, and we don't want the obligation of this 15-year mortgage. So it's like you just can't tell for sure. So the short of the story is discount points are really not a good plan for most circumstances. I will say, though, back in the COVID days, when rates were really super low, I was telling people to buy down.
Yeah, it's a market-dependent thing, right? And this could swing fast. I mean, I don't really foresee it happening too fast right now with the way rates are sitting.
Right.
But yeah, back in COVID, we were locking rates of 2% and 3%. You could get buy down from a 3% down to low 2s fairly cheap, and never touch that. And then at that point, if you do need to touch it, maybe we look at second mortgages or HELOCs or something else,
which is more prevalent. Like it's the exception that those clients are willing, or it makes sense for them to give up the super low rates we helped them get during COVID.
Right.
It happens. So that was just to explain that can happen. But to your point, there's always options. And as rates have increased and we have a bunch of equity that people want to tap into, but they don't want to lose their super low rate, banks are becoming, like, we've had so many second mortgage and HELOC options come to the table that we never had before now. And that's just because that's what the market demands. Yeah.
And every situation is a little bit different too, because there's going to be loan programs that are one-offs that you have to pay points. Like it is what it is, just for it to be an eligible loan on the rate sheet because of loan level pricing adjustments. Like, like some of our portfolio products.
Yeah, for sure. But that's different. Like now the whole psychology of should I pay points, should I not is totally different, because it's like, well, you're doing a bank statement loan. So your choice is you pay the IRS tens of thousands or hundreds of thousands in taxes, or you don't, and you pay 10 grand in points. Well, obviously, like
10 times out of 10, like, it's just
the whole decision making is different at that point.
Yeah, I just don't want anyone going into a loan saying, well, dude, you told me not to pay points. What's this? What's going on here?
So you got us perfectly into the next one, which, does your home and auto insurance seem to go up every year without fail? Mine did too. I thought this was just the way the insurance industry worked until I found my friend Alan Johnson with American Family Insurance. After more than 15 years with the same insurance agent, he saved me over $3,000 per year when I switched. I refer all my family, friends, and clients to him, and their experience is similar. Great rates and a great experience. Call Alan for a free quote today at 801-708-2962. The point I had put on the notes here was origination points. And origination points, unless it's a specialty product, like for us, it's only down payment assistance that we ever charge any sort of origination points.
Yeah.
Other than that, it's just discount points. And if you're seeing origination points being charged by your bank or credit union or mortgage lender of any sort, that's a good sign to maybe pause and get a little bit suspicious on why, because that's not something you should.
And again, this is origination points, not discount points.
That's right, because they are different. But oftentimes we see companies try to conceal the way they're getting the lower rate by charging origination points. We alluded to this earlier, and I think that's just, my opinion is it's a dishonest approach to doing it, because they charge origination points. It's silly. So if you see a lender charging origination fees, like origination points, like a 1% or a 0.5% origination fee, that's a pretty big red flag, I would say. Unless it's a specialty program,
Like our down payment assistance.
Down payment assistance, or to your point, which we never charge origination, but discount points, sometimes they are just inescapable. You can't get around them.
Yeah. Well, even like our down payment assistance ones, we explore pretty much every other option before going down payment assistance because of the points.
100%.
Because it's the most expensive route in the long term. Now,
and you go underwater, and it's just bad. But
and that's not even a fee that like you and I are charging. That's coming from the place where we're getting the down payment assistance from.
That's right. Yeah, it's not us charging it. It's it's a charge of the,
it's just a pass
company. Yeah, of the program. And the only reason I'm glad you bring it up. The only reason that we would go down this path of even doing this type of down payment assistance, because we have some down payment assistance that you don't pay points for, like. We have a grant program. You get absolute free money from Cross Country Mortgage at closing, never have to pay it back no matter what you do. That's awesome. Some of these, though, that do require it, we do try to avoid those programs strictly because the costs are so significant. But it's not better to avoid paying those points and not do that loan and wait to buy, because the cost of waiting is tremendously more significant than the origination points you'll pay. You just have to understand what you're getting into. And the sad thing is that we're noticing is, like, during the COVID era and even just a couple of years ago, so many people got into these programs not actually understanding that they're signing up to be underwater.
Right. And
they bought a house they maybe don't love, or they rushed into something, or they couldn't afford it. And they frankly got bad advice. It's like, I don't think any of our clients have run into this, but I've heard of other clients that have been referred to us to help get out of a sticky situation where it's like they're in this loan now and they can't get out because of that program.
Yeah, I've talked to a few clients that have ran into that. They want to sell, or maybe something unexpected pops up, and at that point you're underwater. You can't just turn around and sell it.
Like, we are seeing people actually short sale because of it. Yeah, which is sad.
So I think if you're going to go with a down payment assistance program, no, this isn't a get-rich-quick thing. This is a long-term investment that it's going to take maybe a couple of years for you to get out. I would say probably 5 years. Yeah, before it's viable to sell.
Four, at least on those down payment assistance.
Yeah, in the market we're currently in.
Yeah.
Unless, it quickly turns around. Right. With equity skyrocketing.
For sure. So we kind of already hit on, like, when mortgage points would be worth it. And it's when you're in a low rate environment, you can buy down to an even lower rate, and you expect that in the future rates will go up. However, you still have to caveat that with, one, you need to think rates are probably going to go up, or at least not get better than where they're at. And of course, no one has a crystal ball, so you're making the best educated guess. But in addition, you have to feel very certain that you're going to hold on to that mortgage. There's not going to be something that causes you to need to sell that property or something beyond the break-even period. So again, we're going back. Like, it is not about the rate. It's not about the fees. In my view, it's strictly solely about the break-even period. And then based on that break-even period,
your plan.
Exactly. And now you just make a decision, but don't make it tunnel vision. Don't make it about the rate.
Last thing I'd add to that is also evaluate your equity in it. Like, especially if this is a refinance, you're talking about buying points. If you've got a lot of equity, do you need to access that right now? Because if so, do a cash out refinance right now when paying down the points, so that way you don't feel stuck.
Right.
Later on.
Yeah.
Because you're like, oh, I bought points. I don't want to refinance. I can't refinance. I mean, you can, of course.
Because you haven't recovered the cost.
You haven't recovered the cost yet, unless, of course, you want to look into a second or a HELOC at that point.
Right, but you do have to be thoughtful. And I would say, honestly, that is where people like us and the LASIG team come in handy in a very big way for clients, is we are thoughtful and experienced enough to walk through these potential what-if scenarios and help coach you through the decision-making. And the reality is, it sucks, but so many lenders in our industry, it's a low barrier to entry industry. So many of our competitors don't even own real estate.
Yeah, no, it's true.
So it's like, how can they guide you on what's best? They have no freaking experience.
Themselves,
But for us, we own lots of real estate, and we've done hundreds, if not thousands of loans, depending on who you're talking to. So, like, we've seen it. And we've been in the business long enough. Like, I've been in the business 17 years. I've seen what clients did, and a few years later, what they call back and say, man, this came up and I didn't expect it. Like, we've seen
and we track the market like crazy too.
Yeah.
Not saying that we're like, have this crystal ball and we know exactly when rates are going to come down, because quite frankly, we've been wrong for the past 3 years. We thought it was going to go down sooner than what it has. But we study a lot of leading indicators that can help you make the most informed decision.
That's the point. Like, you just want to have as much information as possible to make the decision. And you need a sounding board, and that's what we're good at, but we're an experienced one. We're not one that just has opinions. We're not ChatGPT that may just say something that is not valid. Like, this is legit earned wisdom in this industry to help guide you, which is important. Now, paying points, which is our favorite thing right now, temporary rate buydowns. That is one time that I'm like, whatever, dump as much money as possible into paying those points as possible, with one caveat: they can't be paid by you. They got to be paid by a third party, seller or realtor. They have to be, or lender. I guess we can support as well. Dive into why that's so significant and why that's different.
Yeah, and a lot of lenders don't even understand this.
Right.
But reason being is, if you say we do a 2-1 buy down, for those of you that don't know what that is, a 2-1 buy down is you get a lower rate for the first 2 years. Let's say theoretically we lock in at 7%. Your first year, it's going to be locked in at 5%. Second year at 6%. Years 3 through 30, it's the rate at which we lock at, which in this case is 7%. That's your ceiling. It cannot go above that. A lot of people confuse this as an adjustable rate mortgage. Main difference with that is your rate can adjust. There is no true ceiling. I guess there's caps and whatnot, but that's discussion for another day. What's cool about a 2-1 buy down, say rates come down after a year and you do refinance to secure a permanent rate that's lower, maybe right around that 6% range. Any of the savings you did not use for that whole second year in this case comes back to you in form of a principal reduction, meaning you owe less on the mortgage. Or it comes back to you and you can apply that towards points for your next mortgage or closing costs. However you want to deploy those, you can, which I think is powerful. That just doesn't happen with any other discount points. Yeah,
that's the hard thing. Permanent discount points or origination points, you pay them, they're gone forever. You might save some money. Like in that example, it was $167 a month on a $500K house to pay 1 point.
And that lowers your rate by 0.5%?
Half a point, yeah. And it saves you $167 a month. So it takes you more than 30 months to make your money back. Well, if you refinance in 12, you're SOL. If you did a 2-1 buy down, which is more expensive than 1 point, it's about
1 point would still get you a 1-1 buy down.
1-0 buy down.
Yeah, 1-0,
well, even less than that. Honestly, a 1-0 buy down, it's less than a point. So it's like you could probably get a 1-1 buy down for about almost like a point, and a 1-1 buy down is basically just like a 2-1, but you save 1 full percent.
So you're saving $300 a month.
$330 a month for the first 2 years only. But if we expect rates to fall for within the first 2 years, it makes way better sense. And to TJ's point, say the rates fall in a year. Well, you get a refund of any unused portion of that benefit. On the permanent buy down, you're SOL. If you refinance in a year, you've only saved whatever that is. What's $167 times 12? You've only saved $2,000 in monthly payments, but you paid $5,000. So you literally just lost $3,000. Yeah,
60% of your investment you lost.
Right. So it's like if somebody said, you can invest in a stock $5,000 and we're going to pay you $167 per month, but there's more than a 50% likelihood that stock is going to go down in value by 60% before you get your money back. Would you buy that stock? The answer is no.
Hell no.
You would not. And people don't psychologically look at points this way, and that's the reality of it. So,
which I don't blame. It's an emotional thing, and you have to strip the emotions from it.
And you freaking go on Google and it says pay 4 points to get your raise. Like, what the hell? It's crazy.
Seriously.
So I would say you've got to think about the reality, not the theory about, well, if I keep this loan for 30 years or if I keep this loan for some crazy amount of time, look how much money I'm saving. You got to think, what is the reality? What is the cost? What is the reality of when I'm going to change this mortgage? What's the reality of the market? And assess the break even that way. not with some pie in the sky number, because if you did that, you need to look, it doesn't make sense. So in summary, don't pay discount points in this market for sure not. Very rarely are we recommending that. Origination points, unless it's justified with honestly, what do we do? Like 5 or 7 down payment assistance loans that charge these points a year out of hundreds of loans.
We've got so many other options.
Like, we do less than 2 hands worth of those loans out of hundreds of loans a year. So unless there's some real reason that the program requires origination points, walk away. Don't pay them. Go shop it out. Find a new lender, something like that. Temporary buy downs, hell yes, do it. It's basically risk-free, but it has to be paid for by the seller in most cases. But in this market, that's easy.
I would say 80% of the transactions we do have some sort of temporary buy down associated with them right now.
Yeah, exactly. All paid by the seller, and it's like insane amounts of savings. Way better than a price reduction, by the way. So
the goal is multi-payments.
For sure, But I guess, I guess if you want a price reduction, you don't care about your payment. But
if it's all,
you get the same benefit either way. But So I would say lean on us to help you. We actually, because of this specific topic, recently released a new tool. We call it the Strategic Mortgage Audit. So this is a no cost, no obligation second opinion. We will take a little bit of information. It's not a loan application. There's no credit inquiry, nothing whatsoever. We don't even take your social.
It takes less than 5 minutes.
Yeah.
It's super quick.
Hardly any information, just enough for us to assess loan options. You upload any quotes you have, and we'll just review them and compare. 1, we'll determine, can we help do something for a better deal? But 2, if we can't do it for a better deal, we'll advise on a better structure. And even if you don't work with us, we'll give you the advice. We hope, obviously, that we earn your love and trust and have the opportunity to work with you. But certain circumstances, like builders right now, certain builders are doing rates that we can't even touch. But their lenders are not giving high-quality loan structure advice. Like, they may be saying, buy the rate down permanently. So that's where this value can come in. So we'll have a link to that tool below this video, or you can just go to loanselevated.com and you can find it under mortgage audit, or loanselevated.com/mortgage-audit. And you can find it totally free, easy, simple, takes you a few minutes, and you'll get free, really good advice from us. Outside of that, do you have anything else?
No, nothing else over here. We've only had it live for a couple of weeks now, and we've already had clients use it and get great benefit from it. Yeah. People are putting too much money down when they shouldn't have been. Use it, look at it, and if there's anything else you guys want us to cover, please let us know. That's how we come up with this stuff and dish it back out to you. For sure. And please, I think we said this, maybe we didn't, like this video, subscribe to the channel, share the video, comment, do whatever you can to support us. It is, man, we've been at this for years now, and it's freaking hard to get an audience built. And so we rely on everybody watching to take like 30 seconds and do one of those actions: comment, like, subscribe, do something, share it, so that we can get more traction, because we just want to build an audience, and it helps us, in the future, get better guests on for our fuel episodes that you've probably seen, so it's really valuable for us and for you. So please help us with that, but I'm good. Sweet. Cool. Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated. And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.